All right, let me just jump in. And I'm Kent Smothers, professor at the Wharton School and director of the Penn Wharton Budget Model. Today, we're going to talk about minimum corporate income taxes. I discussed with Eleanor Bach and Michelle Hanlon, and really it's leading experts in both tax policy related to this topic. And while this topic may seem like it is on hold for a little bit, in fact, it will be certainly important during after September, as been announced that it will be retaken up in the September period in Washington, D.C. So as typical with our these webinars, it's really a question and answer type format for the most part. In this case, I've actually created a deck just because I wanted to help set the stage a little bit more clearly. And I believe everybody can see the screen. If not, I should be sharing a screen there. Okay. Oh wait, it somehow went away. Is it?
I can still see it.
I can see it too.
Oh, okay. All right, good. All right. So our speaker today, Eleanor Bach, is a professor at Berkeley, economics professor, leading authority in tax policy. Michelle Hanlon, a professor at MIT, leading accountant professor. And again, I'm Kent Smothers. And the discussion rules, as normal, is that the speakers are on record. Best practice, if you're from media, is just to verify quotes with them. You can find their email addresses very easily. Just Google their names. Their email addresses are very accessible. Audience members will include staff in Congress and others, and so they are not to be cited in terms of questions. Even saying a staffer from a representative XYZ's office asked a particular question, even if you don't mention the staffer's name, that is not allowed here. We want to encourage questions from everybody here. And so again, speakers on the record, staffers are not, as well as any audience member. Zoom chat, if you have a question, you can either do this is being recorded, as you know, but your chats will not be recorded, whether you give it to everybody or you just send it to me. Either way, I will try to, if I have time, use the raise hand feature toward the end. So I'd say chat me stuff during the discussion. And if you want to ask your question directly, use the raise hand feature, and I'll try to accommodate that. All right. So this, relative to a lot of the topics we do, this one's a bit more nuanced. And so we have to really give it, some definitions to start with. And so, but it's a first order discussion as well. And just to be clear, what we mean by a minimum tax, that's really going to be the first question here. What do we mean by a minimum tax? And then what do we mean by the base? So the big discussion today on taxable versus what's called financial statement, sometimes called book income. And then the third issue that we'll talk about is, are there potential other options? Of course, there's rates that you could change, but there are other options maybe for base broadening to be discussed. And so be clear, what we mean by a minimum tax is not a surcharge, but really a minimum to clear a threshold. And that could take multiple different forms, but it's basically saying we think a company, a corporation, should be paying at least this certain percentage on income, however defined, that would be part of the discussion, and as a minimum in a given tax year. We'll talk a little bit toward the end about the OECD Pillar 2. There's some interactions that exist there, but a lot of the conversation in DC is not really motivated by that. A lot of it is companies like Amazon zeroing out their tax bill for many or several years. Some pharmaceutical companies also lowering their tax bill, and other companies who have reported zero or low level federal income taxes, often due to different credits and so forth, like R&D investment, ESOP, and so forth, that exist under the current tax law. And so this is where I now will open up for questions for Alan and Michelle in particular. On one hand, we kind of think of you design an optimal tax system. You want to reward certain activity, whether it be investment or whatever that is. That's a debate. But whatever that activity is, are there still remaining strong arguments for kind of any source of minimum tax, or is it what kind of sometimes called kind of third best? And that is, first best would be if we're all knowing and so forth, we could do, really detailed taxes. Second best, recognizes that government doesn't observe a lot of things, include people's individual productivity, things like that. Third best, maybe a more political economy of optics. I mean, maybe I'll start with Alan this, or maybe let me start with Michelle on this one, and then I'll go to Alan. Michelle, your thoughts?
Thanks, Kent, and thanks for having me here. I think it's important when you think about trying to put in a minimum tax, what is it exactly that we're trying to solve? Is it that we need more revenue? Is it that we don't like the perception of some companies having, say, for example, higher financial accounting income than taxable income? Is it certain deductions that we don't like? Or is it that we just, maybe Congress doesn't like companies taking too many deductions at once? And so I think it's important to think about what question exactly it is that Congress is trying to solve when they put in a minimum tax. I think a minimum tax makes things very complicated, and using financial accounting income, I think, makes it much more complicated. And we'll talk about that in a little bit. But I think, kind of the arguments that I've heard for having a minimum tax are kind of the problems that I said before. Maybe companies are having too many deductions. Having one of these deductions is not so bad. Maybe having full expensing, but having too many, maybe some people don't like. And this would be a way to kind of, prevent companies from taking too many deductions. I think there's better ways to solve the issues and the problems that I described before, but those are some of the arguments that I've heard.
Yeah, Alan.
I agree with Michelle. I think the most important question to ask is, what are we trying to accomplish? If the objective is to make companies pay tax, then the next question to ask is why is that not happening through the regular tax system? And I think that ultimately, after responding to the question, what are you trying to accomplish? I think you have to answer another question, which is, why are you not accomplishing that with the basic tax system? And what is it that a minimum tax will do better than adjustment to a regular tax system? And if there's not a good answer to that, then the next obvious question is, why not address this with adjustments to the regular tax system?
Yeah. And so then, Ellen, for you, I mean, let's think about economic incentives of investing just for any sort of minimum. I know it's a pretty broad question because we haven't pinned down exactly our definition of income. But, on one hand, one might say, hey, this is more infra-marginal. After all, it's not necessarily hitting at the marginal investment, but that's not necessarily true either. I mean, because, when we think about how companies have zeroed out their taxes, that's for a given year, not necessarily a longer term investment. But your sense of, in terms of distortions from a minimum tax, outside of even if we thought it was just third best, it's more of a political economy optics argument rather than a second best argument based on information constraints of the government. What do you see as the economic incentives that are impacted from a minimum tax?
Well, it depends on how the minimum tax base differs from the regular tax base.
Yeah.
If there's something in the regular tax base that represents a tax incentive that is added back in, that is a deduction or a credit that then is added back into the minimum tax base, a company subject to the minimum tax at the margin is not getting the benefit of that incentive. A large component that likely would be affected here would be investment expensing,
right,
which at least until over the last few years has been full expensing for qualifying equipment. It's going to be phasing out according to the provisions enacted in 2017. But investment, if an investment expense, if a company is doing a lot of qualifying investment, it could well, even if it's a profitable company, it could well have relatively low taxable income. And therefore could fall subject to a minimum tax if the minimum tax base has less generous depreciation allowances.
Sure.
And so in that case, a company would be, in Michelle's words, using, according to the minimum tax perspective, using too much of a particular benefit, and therefore would have those benefits cut, and that would discourage investment. And it would do it in a different way than, say, just getting rid of investment and expensing in the main tax code, because it would affect some firms, but it wouldn't affect others. And so to use your characterization as third best, what makes it third best is that it's hitting firms differentially. And so to the extent that you think there's reduction in overall productivity caused by giving different firms different incentives to do similar activities, then minimum tax would be subject to that criticism.
Yeah, that's a good point, because different firms have different exposure to depreciation. Michelle, your thoughts?
I agree with Alan 100%. And also, I think it's hard to plan. When you have an AMT or some kind of minimum tax, you have to think through, what years are you going to be an AMT and how will that affect your investment? I think it's harder to plan too, or think about making a decision like an investment decision. So I agree with everything Alan said.
Yeah. Are you concerned at all, either one of you, about counter-cyclical issues being, does the minimum tax present large issues associated with, in some sense, our corporate income tax code? Depending on how you define some things, it's certainly not as counter-cyclical as, say, our progressive income tax code. Are there any kind of macro issues that you might be worried about there?
Well, just on that issue, if you think about a firm that's doing investment and getting investment expensing, it may do a little bit less investment if the economy is in a downturn, but what's really going to be affected are its revenues. And so if you have a tax base based on your profits, the expensing is going to loom large relative to your revenues when your revenues soften, and that's going to make you more likely to get hit by the by minimum tax in a downturn. And so that's precisely what you don't want.
Yeah, it does seem to undo some of the counter-cyclical mechanisms that do exist. Michelle?
Yeah, no, I agree with Alan. I don't have anything to add to that.
Okay, so let's talk about then, the type of income. We've kind of been flirting around this issue, and that is part of the motivation here is both versions of the Build Back Better America, House and Senate versions, both focus on book income. There's been some, confusion about the type of income, but it's clearly net income rather than comprehensive income that's focusing on. And in particular, when we talk about taxable income, this is like a constructed definition. It's kind of tautological. It is defined by Congress. That's what this is. Whereas book income is, of course, defined much more by SEC, given purview to FASB, and that definition of that. So when we talk about book, we mean something close to the financial statement or synonymous for our purposes of financial statement. And before I open up for questions, we've done some calculations on our budget model just to show, we won't spend a lot of time on this, but there are some sizable differences, between taxable income and book income. In particular, some things that will make taxable income much lower than book income in a given year, like depreciation here. We've broken that down to what is temporary, that is about a 1 year change, versus something that we know depreciation even under book income will eventually happen, but more straight line than something like full expensing. And this is just for the year 2019. As Alan pointed out, the full expensing will expire or sunset at some point. And these are other definite differences in types of income. And then some selected differences where certainly we don't have time to go through all this in incredible detail, but there's quite a bit of differences in our definitions of income and what it would mean between the two. So, at first blush, this may seem that, hey, we're just talking about what's in the base, and that is, we can just have big debates about what should be in the base, what the incentives effects are for that. But it seems like there is a bigger, broader discussion about, in some sense, taxable income and financial income. They have different traditional intentions behind them to begin with. Maybe Michelle, why don't we start with you on this one? Like, what do you see as kind of those big traditional differences that existed before this current, discussion between the two types of income?
Yeah, sure. It's really important to keep in mind the different purposes for those two measures of income. So financial accounting is meant to measure economic performance of the company, and that is intended to give information to outside shareholders, including managers' inside information, their judgment about things that will affect their firm. And we give managers quite a bit of discretion in financial accounting in order, that's on purpose, in order for them to give this private information out to external parties. And of course, that's very different than how taxable income is computed, which, like Kent said, is computed, the rules are made by Congress, and it's meant basically to raise revenue and provide incentives and disincentives. It's not meant to give, a measure of economic performance to external stakeholders like investors and creditors. And so the purpose of those two measures are very different, and you would expect them then to come out with very different numbers. In terms of differences, there are quite a few differences, like Kent mentioned, and those differences don't even include the consolidation differences. So how we consolidate entities to make a consolidated group is very different for financial accounting. It's over 50% worldwide. If ownership is over 50%, basically we consolidate it, and the rules for tax are very different. And so even before you get to the differences that Kent was mentioning, you would have to think about the differences in entities that are included in a tax return versus a financial accounting statement. And that itself is quite complicated. And then there are a lot of instances of discretion, like I mentioned, and kind of the simple things would be things like bad debt reserve. For financial accounting, what we're required to do under the rules is basically say when a sale is made on credit, the company should estimate how much of those credit sales, how much of the cash for those credit sales will not be collected. And the company is then required to record an expense for that estimated bad debt that will occur in the future. And there's many examples like that: warranty reserves, even depreciation, you could think. We have to estimate useful lives. Many examples: pensions. There's a lot of estimates that go into how we account for pensions, defined benefit pensions for financial accounting. So there's a lot of discretion in the financial accounting rules that you wouldn't see in taxable income.
Yeah. Alan, your thoughts?
I don't have anything to add to that.
Yeah, it seems like, what you're talking about, Michelle, is that, like, taxable income almost by design has limited discretion. I think Alan's made this point in the past. It's the point of taxable income is to avoid underreporting your income. At the FASB, the intention is to avoid over-reporting in some ways, but it has a lot more kind of discretion. Let's talk about a couple of those things. You mentioned a few of those, Michelle, and the depreciation and bad debt, and there's also goodwill, even things like how we price options. I think that's a kind of an interesting one. FASB treatment of options versus taxable income treatment. Why don't we explain that difference?
And I think you mean employee stock options.
I'm sorry, yes, employee stock options. That's right.
Yeah, so non-qualified stock options. So the way that that's accounted for financial accounting is that on the date of the grant of those options, for financial accounting, we have to come up with an expected value of those options. And we'll do that using some model, like a Black-Scholes model or a binomial pricing model, some kind of model. We're going to estimate the value of those options. And then those options are to be expensed as that employee works for the company, because it's considered compensation. So it's expensed ratably over the vesting period of those options at the estimated value on the grant date. Now, for tax purposes, the rules are different, and the rules are that it's not deducted on the date of grant. The deduction for the corporation happens on the date of exercise. So when the employee goes in and exercises that option, then the company gets a deduction for the intrinsic value of that option, meaning the market value on the day of the exercise minus the strike price, the price that the employee has to pay to exercise the option. So those two numbers can be very different. And if the price is rising of that stock, then the tax deduction will in fact be much greater than the financial accounting expense. Now, I think it's really important to keep in mind that when the company gets a deduction on their financial accounting statement, the employee that has that option that just exercised it, they have taxable income in the same amount on their individual tax return. So it's not, there is a difference between book and tax, but the amount is being taxed in the system, meaning the employee pays the tax on that income and the company gets a deduction. So I think that's something that sometimes people don't consider all the way through.
Yeah. And Ellen, I think you made the point about options. You know, on one hand, as economists, we all think, hey, it's when they're granted, that's when economic value is conveyed. You know, we both remember those debates 20 some years ago. But that doesn't necessarily mean it's the best taxable the tax concept. So
yeah, I mean, I don't know what the argument was for taxing non-qualified options the way they are taxed, but I mean, one very simple possibility is that, you know, if we certainly know it, that we don't need to do any estimation. The way we don't need an option pricing model to figure out the value when it's actually exercised. There we know what the strike price is and we know what the market price is and we have an answer. And so it just in terms of enforcement, it's a much easier way to enforce taxation to have that the event of exercise be the time when the tax is imposed and the deduction is received by the company.
Yeah, and you know, it seems like historically, you know, taxable income is much more trying to limit discretion in many ways in order to come up with, you know, less subjectivity in tax bills. And then, you know, but at the same time, we know that more check the box approach is being less holistic is not necessarily great for allocation of capital, which is what, you know, financial income is trying to achieve.
Yeah,
go ahead.
I was just going to say one thing. In terms of thinking about a book minimum tax versus some other kind of minimum tax, and I don't know whether you're going to get to this, but prior to 2017, there was a corporate minimum tax in place.
Right.
And the difference between that and the minimum tax that is a tax on financial statement or book income is that it was also a calculation based on the information reported to the IRS. It was just calculated in a different way. So a broader tax base, a lower tax rate. And one of the differences between the incentives that would be presented to a company under that kind of minimum tax and the financial statement minimum tax is companies would have no incentive to distort what they report to shareholders and others on their financial statements, because like their regular tax, it would be something reported only to the IRS because corporate tax returns are confidential. And so the traditional minimum tax would involve discussions between the company and the IRS and nobody else, whereas the tax on financial statement income would quite possibly lead to changes in reporting behavior. Yeah.
And let's talk about then the determination of book income and the drill down even more specifically in the Build Back Better provisions, both House and Senate. You know, they have some variations, but they both start with kind of the SEC comes up with the definition of income, and they don't say necessarily, hey, that whatever FASB was of this particular date, they simply say FASB. Then they have an explicit list of differences, how pension treatment, retirement in the case of the Senate version, some R&D credits, things like that. And then there's the Treasury Secretary, you know, discretion. And we're you know, not trying to play lawyers here, so issues about, you know, agency, you know, discretion, sovereign deference, you know, the American Hospital Association, EPA, SCOTUS cases and so forth. Let's put that kind of on hold. But let's talk about more about, does book income provide more discretion to change the law without Congress relative to the current law? Because current law does give some discretion to the agencies. I mean, maybe Michelle, your thoughts.
I'll give it kind of the simple thought and then kind of something more forward-looking that might happen. I think the answer is yes. You know, for example, FASB, the Financial Accounting Standards Board, was just recently for the past couple of years, basically thinking about how to change how we account for goodwill. And right now, what we do is in a merger and acquisition, if there's goodwill paid, the company records that as an asset for financial accounting. In all acquisitions, that's different than tax, but for financial accounting, it'll end up on a balance sheet. And then companies have to test for impairment every single year. And if that goodwill is impaired, they write it down, and there's a lot of managerial discretion in that impairment. Now, what FASB was considering was to go back to a amortization model where they would amortize it this time for 10 years. And just, so that would change drastically the accounting number that would be started with. And, but now just 2 weeks ago, they announced basically that they're not going to change how we do goodwill accounting. They're going to keep it as an impairment model. So it is true, I think, that things can be changed by FASB based on what they think the best measure of economic performance is, given how the companies in the economy are and the different transactions that are occurring. The forward-looking part of this, though, is I think that it's true right now when we have two separate systems, they're not linked, explicitly like we're thinking about doing with the book minimum tax, that FASB could just change rules. Now, the concern is that if financial accounting is somehow the base for taxable income, one concern is that Congress will start influencing the Financial Accounting Standards Board. They have done it in the past, of course, with stock option accounting, actually. Yeah. But where, from an accountant's point of view, the concern would be that Congress would start affecting how financial accounting standards were written more, or prevent them from being written, or require them to be written in a certain way. And I think that would be a huge risk, danger, threat to the integrity of the financial accounting system and to the capital markets.
Yeah, and it's not just accounting, it's like you said, the capital markets ultimately use this information for allocation of capital. I mean, Ellen, your thoughts, and do you see one system as potentially creating more investor risk, for example, than another?
Well, I share Michelle's concern about the, in a sense, having the government cede to a private organization the determination of the tax base. First of all, because it seems to be an abrogation of government responsibility, but it also suggests that there is likely to be pressure, either implicit or explicit, in the future to try to determine, and I could easily see it giving rise to a third set of books, that there'd be, book income for tax purposes and book income for new book income for financial accounting purposes, not contaminated by the tax, the pressures associated with it being part of the tax base. And that just seems another reason to be concerned about taking this approach.
I had not thought of that. Yeah, you can imagine almost a shadow set of books that, even if it's not a FASB thing, it's just, hey,
I mean, companies already have the option of reporting, reporting it according to accounting principles, and then saying, if we did it this way, this is what it would look like.
Right.
There's nothing to keep them from doing that. And, I could easily imagine that they'd feel that, that if there were changes in financial reporting that were induced by the tax, by the book income being included in the tax system, that there would be either informally or perhaps even formally development of a old style way of reporting the income, that hadn't been changed by new developments.
Yeah, that's interesting. I mean, it's related to the next question about having a single set of books and impacting financial reporting. I mean, on one hand, it seems like if they did what you're saying, Alan, hey, what's the big deal to financial markets is they're getting the information through some shadow books or some memo or something else. Not a big deal, but the difference may be that companies can kind of cherry pick when they choose to do that.
If they're not all singing from the same hymnal, then it would be harder for people to understand and interpret the information they're getting.
Yeah, I'm trying to aggregate across that to allocate capital. Very challenging. And Michelle, you've talked about the potential. You've written a lot about this, how financial reporting could be potentially altered by this. Let me ask you. It's actually from you I learned about the 1986 Tax Reform Act, where I knew it had book income, and as for a few years, And I originally thought it was, they tried it in tax reform in 1986, and some of the definitions weren't quite established then, and they kind of reverted. But you actually are the one pointed out that actually was intended to be a temporary provision from the very beginning. I mean, explain all that, because that's pretty fascinating.
That's right. It was put in the code in 86, and it was really meant to last only the 3 years that it lasted. And then they would move to a different type of AMT system on the ACE. And so I think, a lot of concerns were voiced back then about the quality of financial accounting income and how companies might respond and how they might report their financial accounting income. And so I think the very similar concerns that are present today were present then. And so they put it in, but kind of with the thought that, this is kind of a fix for now, and hopefully will assure that they pay some tax, I think was the idea back then. And then it was scheduled to be changed, though, within the 3 years.
So the motivation was you had some companies paying low tax, the minimum bulk would kind of force that at that point, but then we kind of phase out of that. Do you think financial income statements today make it maybe more viable that, we're just kind of, the definitions are better, the accounting's better? Does it make it, or do we just face the really the same issues in 1986?
Yeah, that's a good question. I've written about this quite a lot. I think, we don't know for sure, of course, because we haven't run the experiment, but I think it is true that there is a risk that companies will change how they report. I think, what you have there on the slide, that they're restricting this, or at least the proposal is to restrict this to very large firms. And what you might expect, based on the evidence that we observed back in 86 on the studies that looked at accounting earnings back then, you might expect the effect to be smaller. That's true because larger firms were less willing to manage book earnings to get a certain tax outcome. The other thing that was different was because it was temporary. So in that case, you might expect companies would be more willing to shift intertemporally, income back and forth across this 3-year time period because they knew it was going to end. So we might see a different result, but usually the counter is what you and Alan were just talking about, is that, yeah, but we have this pro forma earnings now, which is much more developed. And so what you might see is companies reporting on the side, like you were saying, you might not see them adjust their actual income, but you might see them reporting this kind of pro forma earnings like they do now, but much more aggressively. And you might see that type of an outcome, which is a risk, because one of the biggest things financial accounting is trying to accomplish is to have comparable financial accounting statements that are consistent over time. And so if you start having companies report this pro forma earnings with too much discretion away from any regulation, then that's a risk, again, to the integrity of the financial accounting system.
Yeah. Alan?
No, I don't have anything to add to that.
Yeah. It does seem like the one-sided nature, the ability to cherry pick, when you report that. Maybe the market would discipline you a little bit if you did radical changes, but still, even if you stuck to it, there could be a lot of variations by industry and so forth, still impacting allocation of capital. So one of my homework assignments in preparing for this was trying to find countries that actually have single book systems that would be similar to if we had an minimum book tax here, where we've moved away from taxable income to financial statement income. I actually could not quite find. Do you know of, and by the way, anybody in the audience, if you know of a country that has a single book system, please feel free to chat me on that. I just not an international expert in that. I wasn't able to find something. Either you two, Ellen, Michelle, know of any countries that have a single book system?
There have been over time, certainly, and there are studies about this. The risk, where researchers will look across countries and look at, generally what they try to look at is the information and financial accounting earnings to the capital markets. And generally what you find is that countries that have more closely aligned book and taxable incomes have less information from financial accounting earnings into the capital markets. And so I think that's pretty fairly established result. It's research, of course, so there's threats to it, but I think that's fairly established, that result in the literature. And, I think just keep in mind that countries with large, efficient capital markets like the US, the UK, we don't have single book systems, and that's for a reason. And that's to keep that financial accounting income in the way that we have it, so it's most informative to the external stakeholders of the firms.
Right, right. Alan, you familiar with any countries that have made that distinction?
I don't. I wouldn't venture to say right now which countries I think. I'm not sure.
Yeah, yeah. I got a message that someone pointed out that it says this is most commonly found in inventory accounting, where the book and tax
Sure.
are aligned.
Yeah, the five,
with,
and there's the and there's been a literature looking at when companies shift from LIFO to FIFO in order to perhaps inflate their accounting earnings and are willing to pay a tax to do so, for example. So there's a small literature on that.
Yeah.
But yeah, why we do it for inventory accounting and not for other elements of the balance sheet, I really can't explain.
Yeah, and somebody else, message that most other countries, they don't have a single book, but they more closely align book and taxable income, maybe Europe, Japan, and so forth. I mean, your thoughts there, Michelle? Do you agree with that, or?
I think it depends. So I think the first thing is to remember that even in the U.S., it's not like they're completely separate. So the current accounts, accounts payable, accounts receivable, those are fairly aligned for book and tax. And in fact, there are studies that examine, what companies might do for tax purposes in terms of income shifting using financial accounting numbers. So, I don't want you to get the idea that there's just no linkage whatsoever. They are, they're aligned in some degree, but they are. There's a lot of differences between the two, and those are for reasons. Either the government tried to put in incentives, or they don't like the discretion we have in financial accounting, and those seem to make perfect sense. So, and it is the case sometimes in Europe, you might see the local GAAP be very aligned with tax income, but when the company consolidates up for the listed shares, that will be on IFRS, and that will be vastly different than the taxable income that gets reported. So there's local GAAP that they might report, and then there's the IFRS that they'll report when they go to list the stock, and that could be quite different. And even IFRS, you might say that it is even more different than GAAP in the sense because they allow companies to write up assets more often than we do in the U.S. So they're more mark to market, for example, than we are in U.S. GAAP. That's one of the differences between IFRS and US GAAP.
And again, if you have those in the audience, feel free to chat me either directly or to everyone, and try to reserve some time if you want to ask a question directly. I'll raise the hand feature if you want to do that.
One thing I just wanted to say is when we're talking about the comparison between book income and taxable income, one of the things to keep in mind is that we often use the tax system to provide incentives, and that's unrelated to measuring income. We sometimes call these things tax expenditures. When we provide firms with an R&E credit, that's not a credit for any expense that the firm has. It's because we are trying to encourage firms to engage in research and experimentation. We could do it differently. We could have a system of government grants for research and development. We could have government grants for investment, and if we did, the tax base would change, and it would look more like financial accounting income, financial statement income than it currently does, and it wouldn't make any difference. And so, it's just another way of emphasizing that the measurement of taxable income is not intended to be, measuring, say, a pure concept of income. That in a world where we use the tax system to provide incentives, one shouldn't expect that, and one shouldn't lament it either if what we're doing is something we're doing intentionally.
Right. I mean, I love your example on everybody talks about R&D, but the R&E example is a good one, because if we think about that, credit is like, economists call trying to correct some Pavlovian externality. If you think that there's some research and experimentation that's not fully captured by the firm doing it, it contributes to the kind of the global knowledge that happens out there. Then you could imagine wanting to have that incentive. But the problem with grants, of course, that really requires the government to know what it wants in that case. It seems that they
Well,
are.
no, I mean a grant just as a percentage. I mean, that is, you could,
Oh,
you can just, instead of saying we're going to have an X% credit, you can just say we're going to have a grant equal to a matching grant equal to X% of your expenditures. It would be identical.
yeah.
Except it wouldn't show up in the calculation of taxable income, and everybody would say, "Oh, we've achieved base broadening." Well, you know, nothing's happened, and it's just that you've changed the form in which the subsidy is given.
Yeah, yeah.
And you can, you know, freely do that within the tax system. But you know, if you somehow get concerned about how you're measuring income, then that's a problem.
And someone in the chat also points out it's not just to encourage, but sometimes to discourage. You know, for example, bribes and certain penalties are not deductible in one book and not the other, or marijuana businesses and so forth. So,
or executive compensation that's deemed to be too
the
high.
cap,
Yeah.
right,
Yeah.
right.
Could you repeat that, Michelle?
Executive compensation that's over the cap.
Yeah,
for example. Yeah.
Yeah. And that's a whole other discussion, and, you know, in some ways about that one, but it's, that's a great example. Let's talk about some other potential approach here for base broadening. And I mean, obviously we could be talking about rates as well, and we can maybe take that off the table for now, or we could talk about, it's up to you, but did some comparisons here. If we think about, Alan mentioned earlier about the Pre-Tax Cuts and Jobs Act, AMT, the AMT versus the statutory rate, some of the major differences between the alternative minimum taxable income, what things are kind of added back when doing the AMT calculation, and then who's subject to a pretty low gates involved and so forth. We estimate that, you know, realistically, if you were to do this ballpark, bring back that AMT, you'd probably maybe get 60 billion over 10 years, something like that. Obviously, the book minimum, at least the Senate version, we have it close to 260 billion, but there's an alternative approach here. And we actually think, you know, Michelle and maybe you, Ellen, are some of the inspiration behind this, and that is thinking about maybe a simpler way of doing it, and that is just simply capping deductions. And the idea there is saying, you know, what's added back is essentially all regular taxable deductions are simply limited in equal proportion to, say, in this example, say 90% of the amount deducted under regular income tax. And in both cases, just to line it up with the book minimum, we had the qualifications, the gates be very similar. Corporations, so 3-year average financial statement income in excess of $1 billion. The NOLs, very similar. Whether, again, we can debate whether those will make sense as a policy design, but try to just focus on this difference in income concepts. So, Michelle, your thoughts about the book minimum versus, you know, simply capping the deduction without necessarily changing the income concept.
Yeah, thanks, Ken. I think it's interesting that you guys did this. I just, you know, I guess the first thing is to step back again and think about what is the problem we're trying to solve. And if the problem we're trying to solve is that they actually have, companies are taking too many deductions somehow. And, you know, like Alan said, we can't fix this through the regular tax system for whatever reason. You know, I think that would be a better option yet than this capping deductions. You know, I think this idea about maybe capping the deductions, if our concern is that companies are taking too many deductions, this seems like a far simpler way to do it rather than, you know, trying to align, figure out what entities are in the financial accounting statements that align with what entities are in the tax return, and then thinking about what differences we want to allow or not allow, and then possibly harming the integrity of financial accounting and our capital markets. Avoiding all those concerns, I think it would be simpler to just cap the deductions. Again, if the problem we're trying to solve is that we think companies have too many deductions. So that was kind of where that thinking came from.
Yeah. And yeah, no, we and Alan,
okay. So I think Michelle started her comments on this with the right question, which is, what are we trying to accomplish? And indeed, if what you're trying to accomplish is to reduce the deductions companies are taking, this is a way of doing it. But I think one one needs to think a little bit about that. So, for example, consider companies in different industries. Industries with very low profit margins, such as the grocery business or something like that, and other industries that have a lot higher profit margins. Or putting it another way, industries with a very high ratio of cost of goods sold to revenues, and other industries with a much lower ratio of cost of goods sold to revenues. It doesn't have to be because of any differences in the competitiveness of the market. It just has to do with how much value added there is, how much by capital in the company. Well, if you just have something that limits all deductions, that would hit much harder the companies where the cost of goods sold have very high ratio to revenues. Even could be an industry effect, and then you'd have to start having different tax rates by different industry in order to compensate for that. So much the way that grocery receipts taxes that exist at some local and state government levels have to have different tax rates for different industries to compensate for the fact that they're in those cases completely disallowing deductions rather than just disallowing a portion of deductions. And you could do that. You could say, okay, this industry typically has a much lower markup over cost of goods sold than other industry, and so we're going to compensate by that by having a different minimum tax rate after we limit their deductions. But after you do all that, you have to ask yourself, what's the point? What's the point of doing all this when you could just adjust the regular tax system to make it serve your objectives more closely?
Yeah, and sometimes it's related almost to the first topic. Do we even need them? Does the minimum tax itself? This is all conditional. If you were to have the minimum tax, think about the basis. And one of the things about the capping deductions, and you pointed this out, Alan, is that when you try to go to financial statement income, you're placing potentially industries that have more weight and depreciation than others, whereas just a flat out cap is a little bit more neutral in that sense. But you're right, you're still back. Doesn't resolve the issue that you just mentioned, that you still have a minimum tax, and why do you have that outside of a third best argument? So a lot of questions are coming in related to international side, so we want to address that, and that is OECD, say Pillar 2. I mean, I know both of you have been following this in some detail. Michelle, I know you've been fairly involved. I mean, what is the current status? And then let's talk about book tax versus other approaches, and also relative to, say, a modified GILTI.
Well, I'll just talk about the current status. I mean, current status is that everybody's waiting for somebody else to move on Pillar 2. So Europe, in particular, requires unanimity to move on Pillar 2, and they've, with the help of the United States, managed to get countries like Ireland in line, but Hungary is currently objecting. And so Europe is not moving yet. The US, well, we know what's happening in the US, which is at the moment nothing. And so, it's out. There's also been this week, they changed the timing for Pillar 1, which it doesn't involve minimum taxes, this minimum tax, but on the other hand is politically, if not legally, tied to Pillar 2, because countries like the US are less interested in Pillar 1 than they are in Pillar 2, and so it may be harder to adopt Pillar 2 alone before Pillar 1 is adopted. So I think that's what the current state of play is.
Yeah. And Michelle, I mean, one of the questions in the chat was, hey, the OECD has already proposed 2 minimum taxes based on global book income. Ostensibly the US supports 2 of the, BEPS pillars. Why not pursue all 3 policies, and how might these kind of interact and so forth? What your thoughts about that?
Yeah, thanks. I think it's kind of important to recognize that the reason why the OECD is starting with financial accounting income is very different than the reason the US used financial accounting income in 1986, and why it seems like we're thinking about using it again in the corporate profits tax. So, in the OECD rules, the main reason, the intent why they want to start with financial accounting income is because they need a comparable number across countries. And like I was saying earlier, financial accounting will get you that because IFRS and GAAP are kind of more closely aligned, and that will be more comparable across countries than taxable income. So for example, when the OECD starts with financial accounting income, and they go through, there's a lot of calculations. They have to compute an ETR ratio, then they have excess profits, and all those will have financial accounting components, but they start with book income, and essentially there's no penalty for temporary differences. So, you know, it's a different purpose. They're going to still have a deferred tax system within that, the OECD Pillar 2, which is another set of complications. But, you know, it's kind of important to remember that the purpose is different, and there will be no penalty for temporary differences. So if a company has vastly different depreciation methods between book and tax, that won't make their, you know, minimum tax higher under the OECD rules. It's just not going to penalize them like it would penalize a company under the AMT that we're thinking about enacting. So there's different, you know, it's a different tax with a different purpose. And I think that's important to remember.
And do you see, relative to, presumably US is going to use some type of modified GILTI to deal with if we try to move into the, you know, conform with the global minimum tax. I'm just trying to understand is how do you think the book tax would compare relative to the modified GILTI, or does modified GILTI kind of still achieve the objectives of this more integration while also trying to achieve the things like incentives and some of the other issues that you brought up?
I think we're going to need, you know, to accomplish all of this, I think we need, these will all be separate taxes in a way. We'll have the tax that you just showed, the book minimum tax on the companies with more than $1 billion. If that gets enacted, then the US probably might want to enact what's called a qualified minimum domestic top-up tax, and then we might want to modify the GILTI to be an IIR, and then, you know, so I think these are going to be all separate taxes, I think, is what we're going to need. I don't think having this book min tax as it's described here and as it's described by the Biden administration will really, you know, kind of substitute for something in the OECD Pillar 2. It's really a separate tax, I think, as far as I understand it.
Alan, your thoughts?
Well, I think that these things have different objectives. The reason why the U.S. is pushing for Pillar 2 is because the U.S. thinks that there are profits that U.S. companies that are currently reporting either, you know, it's somewhere where taxes are very low or where there are no taxes at all, that if other countries adopt a minimum tax, would be brought back to the United States and therefore subject to our regular tax. So they're in a sense the objective for the you know, from the U.S. perspective to it be achieved through the adoption of Pillar 2 is not so much to have the U.S. version of it collect tax in the U.S. You know, on our activities here, but to really get, you know, other countries to you might say keep taking our profits away, and that's very different from the objective of the book minimum tax.
Right. Well, fantastic. I mean, we have a couple minutes left. If anybody wanted to, you've been chatting me great, and I really appreciate all the chats that came in. If you want to ask a question directly, and you can use the share hand feature, feel free to do that. I'll give it a second here in case you want to try that. Otherwise, I guess we can kind of wrap it up here. I'll stop the screen share either way. And Ellen, Michelle, coming up to our hour here. Any closing thoughts here that you want to impart?
You know, I thank you for having me on, and thank you for everyone being here and listening to this. I think kind of my just one word of caution would be to be very careful when you use financial accounting income as part of the tax base, because we really don't want to risk harming, I think, the financial accounting system and the capital markets. So just be careful how we consider that, and we do so carefully.
And Ellen, thank you.
Yes, I would say, again, whether considering this particular minimum tax or any alternative potential minimum tax, one should ask the key questions beforehand. What is it we're trying to accomplish? Why can't it be accomplished through the regular tax system? And what additional inefficiencies and complexities will we be introducing if we try to accomplish this through some form of minimum tax or another? And of course, it'll be different. The answer will be different depending on what the minimum tax looks like. But those are questions that one should ask regardless of the minimum tax. And ultimately, I think if the minimum tax somehow grows out of frustration that the regular tax system isn't doing its job, then I just don't find it logical to think that somehow you can make come up with a parallel tax system that will do the job better.
Fantastic. Thanks for your insights. Thanks, Alan. Thanks, Michelle. Really appreciate it.
Thanks.
Thank you.
And thanks to everybody out there. We're at the end of our hour, and please join our email list if you're not on there, and we'll hopefully see you in a future presentation as well. Thanks so much, everyone.